I started out this week writing about First Solar, and specifically, they had announced an acquisition of a new company that allows them to make a pretty novel push into more energy efficiency for PV cells. And what's interesting is investors heard the news about this acquisition and bid up First Solar's stock price by 25%. First Solar is already very richly valued, and so I wrote a post about just how strongly valued First Solar was, how much more valuable it was from the market's perspective coming out of that acquisition. And I compared it to some other companies in more traditional energy spaces to really get a sense for how aggressively investors are thinking about the potential for First Solar. My next post was about ONEOK buying Magellan. And that is an incredibly interesting combination of two midstream oil and gas players for a number of different reasons. I specifically honed in on the fact that part of the rationale for that combination was it would make more capital available for capital investments, for growth. And the idea there is that with more free cash flow generation, there's more ammunition to go invest in the combined business. Those two businesses in isolation would have a harder time finding the capital that's necessary to go grow, specifically ONEOK. But if ONEOK can bolt the Magellan cash generation vehicle onto itself and then use that cash generation to invest more aggressively in the combined business, then you could see more investment across the oil and gas midstream sector with this combined entity than you would have if they had run separately in parallel. So that one was pretty interesting. The next note was about NRG, and the activist investor Elliott took a $1 billion stake in NRG this week. And Elliott, was pretty aggressive about why it's taking the stake right now and what it thinks NRG could do better. Specifically, Elliott had talked about unwinding the acquisition of Vivint that NRG had made. And Vivint is a maker of smart home technologies. I wrote a post about how Elliott makes a strong case for why that acquisition needs to be unwound, why there's financial incentives in place to do that. What I wrote about was that is still, that combination with Vivint was a strategically coherent move. It is complex and it will take time for NRG to realize, and they may not have that time if they've not won over investors around the vision for that acquisition. So that's going to be an interesting one to watch as we see how the tension around that company's go-forward strategy resolves. My next post was a quick hitter about nuclear power. We got a new advanced nuclear power report this week from a couple of industry trade groups, and that comes on the heels of a similar report about advanced nuclear that we got from the Department of Energy back in March. And so I just made the point that, hey, if you're interested in advanced nuclear, there's a lot of conversation taking place in that space right now. We're getting really good, interesting, meaty investor reports there. And so I offered a couple links for some reading material if you're interested in that sort of thing. I closed with two posts about oil and gas. My first one was that seasonal demand for petroleum products here in the US is below where it was in the pre-pandemic. Specifically, the last 4 weeks, we're seeing demand below what it was in 2016, 2018, and 2019. So that's the bad news in a sense. But the good news is we continue to see recovery in demand coming out of the pandemic. We've had year-over-year growth in 2021, 2022, 2023. Product demand, petroleum product demand is something I pay a fair bit of attention to because it correlates so strongly with economic activity across the US. And so it's an important measure to understand what the state of the US economy is. So it is growing slowly, still not at levels demand-wise that we had seen before the pandemic. So there's still room to expand there. My last oil and gas post was about US drilling, and we got new rig count data on Friday from Baker Hughes. And we've seen that in the past 6 months, the US has lost 62 drilling rigs. And that is the worst 6-month performance since the depths of the pandemic, when we were shedding drilling rigs at a record pace. So we had seen through 2021, 2022, into the very first part of 2023, we had seen net adds every 6-month basis in that window. Now we're seeing declines. We started seeing them in February, but the declines are really ramping up now. The past 3 weeks have been really rough for the US drilling rig count. And so it's one reason, frankly, to be a little bullish about oil prices from here is that the U.S. Oil and gas exploration and production community is not aggressively pursuing production liftoff from here. So there's structurally some supply issues that even if demand starts pushing pretty aggressively forward from here, whenever that might happen, the supply side's pretty constrained. So we could expect oil prices to move up a bit at some point in the medium-term future, say. Those are my notes from this week. As always, I publish a weekly energy newsletter that goes out on Saturdays, where I include links to and summaries of all of the research pieces that I shared through the week. I also include an energy-related anecdote, insider observation. So even if you've seen all the stuff that I share elsewhere, there will still be something new for you in the newsletter. In this week's newsletter, I wrote about the U.S. federal government approving a pretty important transmission line for U.S. renewables for wind coming out of New Mexico. And it's an important win when it comes to project approvals, but it also shows how much work we have to do to get to a point where we're building out the way we need to. So I shared that in the newsletter. If you're interested in seeing any of that stuff, feel free to sign up. It's totally free. I appreciate you reading, and we will talk soon.